For millions of Americans, the 30-year fixed-rate mortgage is more than a financial product. It's a cultural institution. It has shaped the suburbs, fueled the housing market, and given generations of families the stability to buy homes without fear of sudden interest rate spikes. Yet beneath the security it promises lies a complex history, a set of pros and cons that could make or break a homeowner's financial future, and a growing debate about whether this decades-old tradition still serves the modern buyer. So in this video, we will discuss 30 years to freedom, the rise, reign, and risks of America's favorite loan. But before starting the video, be sure to smash the like button and subscribe to never miss out on any of our videos. By spreading payments over 30 years, the FHA and other government-backed programs made homeownership affordable for the middle class. The 30-year mortgage was born not as a banking experiment, but as a social and economic policy tool designed to prevent another housing catastrophe. Why the 30-year mortgage became America's favorite? The appeal of the 30-year mortgage is simple: low, predictable monthly payments. By extending repayment over 3 decades, borrowers can afford more expensive homes without a crushing monthly bill. The fixed interest rate also provides stability, insulating homeowners from sudden spikes in borrowing costs. For lenders, these loans were initially attractive because government backing reduced risk. For borrowers, they offered a pathway to homeownership that didn't require saving for years or facing financial ruin at the end of a short-term loan. Over time, this loan structure became not just popular but culturally ingrained, a symbol of the American dream. The economics behind the 30-year loan. From a purely financial perspective, the 30-year mortgage comes with trade-offs. Longer loan terms mean more interest paid over the life of the loan. A borrower with a $300,000 mortgage at a 6% fixed rate will pay about $347,000 in interest over 30 years, more than the original loan amount. However, the affordability of monthly payments often outweighs the long-term cost for many buyers, especially in an economy where wages grow and inflation erodes the real value of those payments. Historical turning points in mortgage rates. Mortgage rates have never been static, and the story of the 30-year loan is shaped by dramatic shifts in interest rates. In 1981, rates hit a record high of nearly 18%, making monthly payments prohibitively expensive and putting homeownership out of reach for many. In the aftermath of the 2008 financial crisis, rates dropped to around 5%, creating a surge in home purchases and refinances. Then came 2020, when pandemic-driven monetary policy pushed rates to an unprecedented low of 2.65%, sparking a refinancing boom across the country. Each of these moments didn't just move numbers on a chart, they reshaped the housing market and influenced the buying decisions of millions. Pros of the 30-year mortgage. The 30-year fixed loan remains the gold standard for many reasons. Its predictability allows families to budget without fear of interest rate hikes. The smaller monthly payments provide flexibility, freeing up money for other expenses or investments. It also offers a hedge against inflation. As the value of the dollar decreases, the relative burden of a fixed payment becomes lighter. For first-time buyers, this stability can be the difference between entering the housing market or being locked out entirely. Cons and hidden costs. However, the 30-year mortgage isn't without its downsides. The most obvious is cost. Stretching payments over 30 years significantly increases the total interest paid. Additionally, because monthly payments are lower, borrowers may be tempted to buy more house than they can truly afford. The long repayment period also means equity builds slowly, making it harder to tap into home value for emergencies or upgrades. Another subtle risk lies in the opportunity costs. Money spent on mortgage interest could be invested elsewhere for potentially higher returns. Financial experts sometimes recommend shorter terms, like 15-year mortgages, for those who can manage higher payments. Historical rates of the 30-year mortgage. The interest rate environment plays a massive role in the mortgage market. In the early 1980s, rates for 30-year fixed loans soared about 18%, a figure that would be unthinkable today. In contrast, the 2020 COVID-19 pandemic era saw rates drop to record lows near 2.65%, igniting a refinancing boom and pushing home prices upward. Here's a graph of historical 30-year mortgage rates. These fluctuations show how macroeconomic conditions, inflation, Federal Reserve policy, global crisis, directly influence the affordability of the 30-year loan. Real-life scenarios. Consider 2 homeowners. Sarah chooses a 30-year loan and invests her $500 monthly savings compared to a 15-year loan into the stock market. Over decades, her investments grow enough to outweigh the extra interest she paid on her mortgage, leaving her both a homeowner and an investor. Mike, on the other hand, takes a 15-year mortgage, pays more each month, and becomes debt-free by 45. He enjoys financial peace of mind early but has less invested capital during those prime earning years. Both paths have merit, but the outcomes highlight how personal priorities influence the best mortgage choice. Inflation's hidden impact on the 30-year mortgage. Inflation is often seen as an enemy to consumers, but for fixed-rate mortgage holders, it can be a quiet ally. As wages rise with inflation, monthly mortgage payments stay the same, effectively shrinking in real terms. Someone paying $1,200 a month in 2000 is paying the equivalent of much less today in inflation-adjusted dollars. Of course, the downside is that periods of high inflation often bring higher interest rates for new borrowers, which can lock people out of the market. Technology's role in the mortgage evolution. The mortgage process of the 1980s was slow, opaque, and paper-heavy. Today, technology has transformed the game. Online rate comparisons, instant pre-approvals, and AI-powered underwriting have streamlined applications and increased competition among lenders. Borrowers can secure better deals faster, but this speed also encourages impulsive buying decisions, a double-edged sword in a hot housing market. Global comparisons. Why the 30-year mortgage is uniquely American. In many other countries, such as Canada or the UK, long-term fixed mortgages are rare. Loan terms are often shorter, with rates resetting every few years. The U.S. stands out for offering decades-long rate stability, largely due to the government's role in supporting the secondary mortgage market through entities like Fannie Mae and Freddie Mac. This stability, however, comes at the cost of greater long-term interest accumulation for borrowers. Alternatives to the 30-year mortgage. While the 30-year fix is popular, it's not the only option. The 15-year fixed mortgage offers lower interest rates and faster equity buildup, but comes with higher monthly payments. Adjustable rate mortgages, ARMs, start with lower rates that adjust over time, which can be advantageous if you plan to move within a few years. Interest-only loans and hybrid ARMs also exist, though they carry higher risk if home values drop or rates rise sharply. Psychological and cultural significance. For many Americans, the 30-year mortgage isn't just a financial tool, it's a rite of passage. Signing those papers marks the transition from renting to owning, from uncertainty to stability. It's tied to broader narratives about family, legacy, and the pursuit of the American dream. This emotional dimension helps explain why the 30-year mortgage has endured even when shorter, more cost-efficient options exist. The future of the 30-year mortgage. The 30-year mortgage has weathered wars, recessions, housing bubbles, and pandemics, but its future isn't guaranteed. Rising interest rates, tighter lending standards, and changing economic realities could push lenders and buyers towards shorter terms or more flexible products. Technology-driven underwriting might open the door for customized loan durations, while shifts in government policy could reshape how mortgages are funded and insured. Whether it remains a mainstay or slowly fades, the 30-year mortgage will continue to reflect America's evolving relationship with debt, homeownership, and financial security. Thank you guys for watching. If you want more videos like this, make sure to like the video and hit the subscribe button, and we'll see you in the next video.